Hi everyone, warm welcome to Accounting 321 Strategic Cost Management. This is lesson number 1, and what we are going to be doing is an introduction to strategic cost management. Before we jump into what strategic cost management is, let's just define what management accounting is. This context really helps because as you go through this course, you will see, unlike other accounting courses, we don't focus on traditional models, frameworks, or concepts where there is an external body such as FASB guiding us in mandating certain methodologies. In fact, managerial accounting is actually very dynamic and something that's evolving quite recently. What you have here is the different flavors of accounting and accountants. For those boxes in red, there is an external stakeholder who is driving a lot of the requirements. So the classic public accounting is essentially guided by FASB from regulatory perspective. Internal audit, on the other hand, is again guided in terms of what their mandate should be by the board of directors, which is to maintain and enhance the internal controls of an organization. Managerial accountants are a stark contrast to the earlier two briefs that we just discussed. What managerial accounting as a profession comes down to is partnering, planning, formulating, and implementing strategies, because ultimately that's the mandate for managerial accounting. Now, what does this mean from an evolutionary standpoint for strategic cost management and managerial accounting? In chapter 1 of the book, the authors do a great job discussing this article called New Wine or New Bottles, whereby academia is essentially challenged the very notion of what cost management is and what it's doing in our industry. It is really playing to the definition, which is driving insights and supporting business partners on insights. What we have seen over the last 15 to 30 years is a gradual evolution in cost management, and part of it has to do with academia and professionals like yourselves throwing their heads in and trying to redefine when and how cost management can play a role, or essentially how cost accountants play a role in driving company strategy. Starting from the left, the lowest value add is your typical cost management. Budgeting, forecasting items are where you have an analyst or an accountant who's just looking at historical trends or getting guidance from some sort of an external cost driver and building projections out. Essentially, that's how cost management really started, because ultimately what cost management is are you hitting your budget or not, and are you able to forecast your costs very well so company can scale up or down as needed. Managerial cost analysis took that step further. So cost management just the mechanics of trying to give high-level managers and executive inputs to how their company is doing on major cost. Managerial cost analysis tries to actually provide insight, so whether it be a variance analysis or another technique, managerial cost analysis basically did some attribution analysis, where now as an executor could tell, are my margins expanding because I have economies of scale, or is it because I have some sort of pricing concession from a supplier, or both? So that's what really managerial accounting focuses on. Strategic cost management, on the other hand, is very different, and that's what we'll be spending most of our time. One key takeaway here is we are not going to be doing your standard activity-based costing models or say variance analysis. That's what we did in Accounting 320, and that's not the purpose of this course. The purpose is actually to take those tools as given and take it to the next level, where it's really operating with executives to drive to try to drive high-level strategic level decisions as opposed to just reproducing data in a certain format. We will touch on this to this point a lot in chapter 2. So what's really relevant from a definitional standpoint is what's the purpose of accounting information? It's important because it is A, the language of business, so from reporting standpoint, and B, it provides a standard reporting package that enables some sort of completeness check and comparability, whether it's to internal to an organization or to external benchmarks. It also helps you analyzing, and is particular project effective, is the firm operating efficiently, effectively, and ultimately it's monitoring the performance of the business as a whole. Is management able to expand operations and execute well? How do we measure that? You can either do it by sales or by profitability or combination of these two. Accounting is really about defining, reporting, and analyzing, monitoring the performance of an organization. The purpose of strategic cost management, again, is it ties really closely with the definition of managerial accounting, which is defining, reporting, analyzing, and monitoring key financial and non-financial metrics. And that's sort of your typical definition that you'll probably find in the Institute of Management Accountants or even the textbook. Really what this is saying is, unlike a conventional accountant, what a strategic cost management does is it looks beyond just taking what is an external mandate from a framework or guidance perspective, from how costs should be classified or how revenue should be recognized. Instead, it's really going one step further and actually creating customized reports, whether it be financial or non-financial in nature, and support strategic level, high level decisions. These are the three key themes that we are going to touch in strategic cost management. The first is value chain analysis, the second is strategic positioning analysis, and the third is cost driver analysis. There are plenty of analyses, frameworks, and concepts. It's important for you guys to know that what we are trying to do in this course is really to step away from talking about specific frameworks, which we will get into in a moment, rather than to talk about actual types of analysis that are embedded in each framework. This will become a little clearer as we go through it, and we will have a few illustrative examples to prove the point. Generally, the idea here is these are the three themes that we will touch on throughout the course. So, what's value chain analysis? This is a typical Porter's value chain analysis that you are going to find when you do a simple Google search or review any academic paper. The idea is quite simple. What are you as a firm involved in terms of the activities? The boxes you see here are operations, logistics, marketing, sales, and services that really represents your conventional value chain. We will actually go ahead and construct value chains for an oil and gas industry. The ultimate idea is the primary activities encapsulate how goods or services come in and how the value that service is produced and where the margin is gained. In addition, we have these support activities or overhead that are essentially enabling these primary activities. A value chain analysis really breaking up an organization's ability and organization structure into these components so you understand where its profitability is coming from and where exactly do we want to function as a firm. Strategic positioning analysis is Once you have actually built this entire infrastructure to actually produce a good or service, where do you want to be in the landscape of competitors for your products and services? This is really the perceptual map or joint space configurations, and that's just a fancy way of saying when you put the two attributes for a particular product, in this case let's say product differentiation versus cost or whatever the actual attribute might be, the idea here is, as a company, you have the option to position yourselves like Toyota, which is very practical, low cost, low product differentiation products. Strategic positioning analysis here is volume, and we have a low cost base. This is Toyota has little cost base, and they are trying to rely on volume. The shark, for the contrary example, one could say it's Mercedes. You are really a premium car out there, so it's going to cost you more, and that is the intent of the management. You want to attract customers who are willing to pay a premium for a product because you have invested so heavily in that product, and it's not a volume game at that point. You are really trying to extract a higher margin on a premium product. That's conventionally how people have thought about this. As you increase product differentiation, the cost will increase. There are firms out there that are obviously breaking this norm. The classic example comes to mind is Apple. We have a high product differentiation and low cost. In fact, if you take an iPad or if you take an iPhone series from cost standpoint, it's really comparable to Android or any other platform that's available out there. So it's an important facet directionally to remember that obviously you increase differentiation, the capabilities for products or costs escalate, but firms like Apple, who are able to actually optimize their value chain so much that they can choose to actually position themselves as a high premium product. Instead, what they have chosen to do is not just position themselves as a high premium product, but also make themselves as a high volume product where they demand something like 50 to 60% of the market share on smartphones and some similar number in the tablet industry. So what cost driver analysis is, you are incurring certain costs in an organization and you really want to understand what's driving those costs. Cost driver analysis really is understanding how your cost structure behaves, not just in a static sense, that is not just going to look back, but also tying back to the organizational infrastructure and the strategy at a higher level. This section, which is part of part 2, is to really give you guys a preview of various conceptual frameworks, and in my opinion, the reason why we have so many frameworks and so many ways to teach strategic cost management is in stark contrast to your 4 to 5 other flavors of accountants that we fleshed out earlier. Key stakeholders, let's say public accounting or internal audit, they want standardized information. Some of them are primarily investors. They want consistency and compatibility, and reports or data that are presented to them. This is a very sharp contrast to what cost management or managerial accountants do. The focus is not on external stakeholders. The focus here is really on internal stakeholders, where a manager is really trying to understand, for example, how to scale a particular business. At that point, he is not really thinking about revenue recognition or cost recognition or what type of overhead to allocate. Where he is really thinking about is fundamentally, tell me what is the economic value added from this product for the company, which is, don't just give me the typical accounting guidelines, which may or may not have limitations. You know, they tell me ultimately what is this costing me and how can I improve profitability, and it's this lack of consistency and clarity that is fairly kind of parallel with the evolution of cost management. And what academia and some professionals have tried to do, at least say, look, I understand that we can't mandate one particular framework across all industries and all companies because businesses change and business requirements and what the stakeholders are looking at constantly changes. But what we can do is to at least streamline some of those processes into some general buckets or frameworks, and these conceptual frameworks are what we are going to be covering on over the next few slides. When we talk about strategic cost management and the conceptual frameworks, one of the first names that comes to my mind is Robert Kaplan. He is an exceptional professional when it comes to looking at cost management type issues. He published a book, The Relevance Lost, The Rise and Fall of Management Accounting, where he really challenged and criticized the then existing frameworks. And the response to this paper, and of course his research contributions to the field, have been the evolution of these frameworks. There are a lot of frameworks here, and the key disclaimer I want to have here is they are not mutually exclusive, and in fact, more often than not, you will find a lot of these frameworks put in one place at the same time. What this really is a guide for cost management accountants, and to basically address the needs of the stakeholders. A lot of it depends on the context and the situation that the company is getting into. When we continue thinking about the conceptual frameworks, there are 7 here, and in terms of what we are going to cover, the first is target cost management, and we are going to cover everything all the way to integrated cost management. So let's start with target cost management. Target cost management is very much a top-down approach. I'll tie back to our 3 themes of our analysis, which is the value chain analysis, the strategic positioning analysis, also the cost driver analysis. This is really a combination of the strategic positioning and the cost driver analysis, where the company first decides where do we want to play, do we want to be a premium product and garner high margin in your business, or do we want to be a low-cost product and rely on volumes. That gives you your price. Ultimately, what you are going to do is to look at what's your desired return level. If the industry's desired return or required return, whether it be an external benchmark for investors or internal rate of return projections that are required by management, you are going to basically back into the cost model. It is the cost management's role, taking the market prices given and reverse engineer a value chain, or reverse engineering into cost driver analysis to basically drive down costs to defend a certain desired return. The whole notion of target costing, you are targeting a particular cost based on the margins you need and based on the standard market price that you are given in your industry. Asset management is a little different. The way we would think about asset management is it's really a model that's akin to Wall Street. You are looking at the rate of return of investment on your assets. And they are very common industries such as oil and gas, where you're building all these rigs across the world, massive, really big investments, about $3 to $7 billion. And the semiconductor industry, where you are wrapping up fabrication plants, and ROI analysis is absolutely important, because you are not just looking at it over a year or two, and you're actually looking at that particular large investment over 10 to 15 years. Ultimately, from strategic cost management standpoint, and again tying it back to our three themes, this ties very well into with the cost driver analysis, because a lot of the projections are going to be based on external data. The reliance on you as a manager accountant is really going to really feed that strategic cost management decisions around what is really driving cost, and in long term, how can the firm reduce the cost over the next 5 to 10 years. Extended enterprise really speaks well to the value chain analysis concept. The classic example here is the US auto industry, where they integrated up and down the value chain with the suppliers as well as customers. So think of Ford or GM in 2008. There was a debate in the Senate where a lot of senators were arguing that GM going bankrupt isn't just disaster for GM and the employees there, but it's a disaster for over 3,000 suppliers that are located in there around the Detroit area. Now, how did this happen? Ultimately, the idea was for GM to partner with the suppliers and make them 100% reliant on GM, and make GM 100% reliant on them. This is technically not a vertically integrating into a particular value chain. That is, you are not going and actually acquiring these suppliers, but you are basically getting into good partnership or long-term partnerships. The idea here of an extended enterprise is, how do you redefine your value chain to either protect your margins or improve your costs over time? You are really redefining, for example, what a company could and couldn't do. Capacity cost management is something you are going to see in heavy manufacturing or semiconductor type firms. The idea here is optimizing your product function. It is a combination of really looking and understanding your sales projections and how your markets are doing, and even tweaking to some of this to some extent your strategic positioning. If you are in an industry where there is a lot of new entrants, historically you may be a premium product. Microsoft comes to mind as a good example, but lately with the entrance of Apple, Google, Facebook, Microsoft's position as a monopoly, even in enterprise solutions or customized solutions like Windows, is somewhat challenged. So capacity cost management at that point really becomes based on your resources and based on your capacity. Are you optimizing, let's say, your engineering footprint? Are you optimizing your fabrication plants or output so that you're able to really defend costs and expand margins profitably in the long term? Process management drives through the value chain analysis, and this is really interesting. When we think about process management analysis, it is your typical optimization stuff, like your Six Sigma projects, where you basically do cost benefit analysis on saying, hey, look, if I have 99.99% of defect rate, that means lower returns, and that means my brand value increases. And this is a classic approach that someone in the technology space would use. A Japanese firm take Kaizen, which is continuous improvement, but we want to think about it more than that. Think about industries like pharmaceutical industry. We are having a defect, or even on one drug, may not just mean that you have a return, but it could actually close down your entire business. Or think about businesses like Google or Facebook. What if that user information and all that sensitive data these companies collecting got leaked to a malicious party? What happens then? That's essentially an end game for an industry that's about $300 to $400 billion. So process management goes beyond just thinking about how do you optimize your processes and reduce costs. It also tries to identify where your real risk areas are, like the pharmaceutical or Google or Facebook example, and really invest the appropriate amount in developing appropriate assets to protect or mitigate those risks. Activity-based management is a combination of cost driver analysis and value chain analysis. What we are doing here is really associating specific activities that folks are doing to a particular cost. So if you have procurement process where you are really creating a PO and you are entering vendor into the system, there may be different parties involved, and it may take different art from in terms of those labor costs to say create a PO in the system and then expedite the purchase order and actually support supply operations, which is actually putting the relevant vendor data like their checking account, their legal entity, their addresses, and things like that. These allocation schemes become important from strategic cost management standpoint because you are really trying to understand what's driving your cost, how can you optimize your cost, defend the company's strategy from a product standpoint. So activity-based management really helps you identify those hidden costs, especially when you think about your value chain on all those overhead costs like support functions. What if, for example, you have an HR function that is in an engineering firm? Let's use an example, Google, that's spending more than 50% of its time on non-engineering resources. It's not a good thing or bad thing because from an activity-based management standpoint and from strategy standpoint, one would expect that as an engineering company, most of those costs and resources are being allocated to engineers and not to non-engineering functions. So think beyond just breaking out cost accurately. Think also about the assumptions and insights that you can bring to management when you do good activity-based management. The last section is the integrated performance management. At the highest level, what you are doing internally to incentivize your people to maximize shareholder value. Integrated performance management drives across functions. A very common tool is, for example, is stock options, common in the Bay Area. Why do we give people stock options? We give people stock options because we want everyone to be a good partner in the firm and actually drive, whether it be process improvements or cost improvements. So does it really make sense to give stocks? Should it be performance-based bonuses? These are all valid questions as you are going to see throughout the course. There isn't one specific right or wrong answer. Instead, you are going to look at the broader picture from executive level perspective. And that pretty much summarizes the lecture one here. Thank you for watching the presentation, and as always, if you have any questions, please contact me. Thank you.